U.S. natural gas futures pushed above $4.60 in thin Thanksgiving trading as the market priced in stronger demand and the likelihood of a deeper-than-normal storage withdrawal. Fresh forecasts keep temperatures below seasonal norms through December 10, a stretch that should lift residential and power sector consumption. At the same time, LNG exports continue to accelerate. Flows from the 8 major U.S. terminals averaged 18 billion cubic feet per day in November, well above October's already record-setting 16.6 billion cubic feet per day, adding another layer of demand pressure. The latest storage report confirmed the tightening trend, showing a larger-than-expected draw during only the second week of withdrawal season. Even so, the supply side remains exceptionally strong. Lower 48 output averaged 109.7 billion cubic feet per day in November, topping October's 107.4 billion cubic feet per day and breaking the previous all-time high of 108.3 billion cubic feet per day set in August. Abundant production and still healthy inventories continue to act as a counterweight to the emerging winter bullishness. Meanwhile, European natural gas futures continue to slide toward €29, marking their weakest level since May 2024. After reports indicated that Ukraine had agreed in principle to a revised peace framework with Russia, though the full terms are still being negotiated. Even the possibility of a US-backed settlement has stirred speculation that Russian pipeline gas could return to the market in greater volumes, adding fresh downward pressure to European benchmarks. This shift also introduces a meaningful risk of a sharp correction in US natural gas prices, which remain stretched relative to fundamentals. Much of the current U.S. premium has been built on two pillars, geopolitical tension and colder-than-normal winter forecasts, yet both drivers are already well priced into the curve. With winter risk largely accounted for and geopolitical momentum shifting, January to May U.S. futures are increasingly vulnerable, making a pullback toward $3.50 look reasonable. Even the EIA is projecting a similar moderation as winter progresses and supply remains robust. From a technical standpoint, January futures once again failed to sustain a move above the 200-day moving average, reinforcing that this level remains a firm ceiling rather than a springboard. After repeatedly losing traction there, the contract has continued to grind lower, signaling a clear shift in trader psychology. What had been a buy-the-dip environment is gradually evolving into a sell-the-rally setup, where every bounce is treated with suspicion rather than optimism. If this downward drift continues, the market is increasingly likely to retest the 50-day moving average, which now stands out as the next meaningful support zone. The only force that could disrupt this developing trend would be the emergence of a significant, well-timed cold spell, something strong enough to materially alter demand expectations and force shorts to cover. Without that kind of weather catalyst, the path of least resistance remains tilted lower. Don't forget to drop a comment, hit that like button and support the channel if you'd like to help keep this channel going. See you in the next one.